Hello and welcome to Nothing Venture with me, Aarish Shah. Today in the studio with me, I have Alokik Advani. Alokik is managing partner at Fidelity International Strategic Ventures, building and investing in FinTech businesses and technologies that are strategic to Fidelity International. Alokik's career has spanned over 2 decades in finance, setting up a strategic investment unit to Merrill Lynch in Europe, after which he spent a decade building out Goldman Sachs' strategic investments team and practice in Hong Kong before joining VC firm 8 Roads as the MD for FinTech Strategic Investments. In today's episode, we talk about whether or not corporate ventures only provide the dumb money and overpay, how strategic investors are now involved in 20% of deals or more, why founders shouldn't dread the down round, how startups can outlast a 10-year fund structure, why if it isn't easy to realize returns, everything slows down, how there's been a mindset shift to becoming the $100 million ARR company rather than the billion-dollar valuation company, and Alokik's contrarian advice: slow down and take your time. Let's get straight into it.
This is Nothing Ventured with me, Aarish Shah, the podcast where I talk to the people behind the stories that make the venture capital ecosystem go round. I've been working with startups from pre-seed to Series C for the last decade, and companies that I've worked with have gone on to realize value and exit or raise funds in excess of $500 million. I really hope you enjoy the episode, and if you have a guest that you'd love to see me have on, or you have a comment on any of the episodes that I've recorded so far, do reach out to me on LinkedIn or Twitter. I'd love to hear from you. Let's get straight into it.
Alokik, really great to have you here in the studio with me. Thank you so much for joining. Let's dive straight in. We've had a few guests on the podcast who have either directly or tangentially been involved in corporate venturing. But in general, CVCs, corporate venture capital kind of firms, seem to have a bit of a bad rap in the world of venture. So can you break down the different flavors of corporate venturing from your perspective and why Fidelity specifically decided to build out a venture arm?
All right, so let's first start with the bad rap. Oftentimes you get painted with this brush of you're either slow moving, or you're the, let's call it quote unquote, dumb money likely to overpay, or you're not going to stand up to the strategic promise. Now, given the nature of large organizations, you can see how sometimes that decision making can be cumbersome. You can be tagged with that moniker of VC tourists when the waves are good versus the waves are bad. Corporates can go in and out of flavor in terms of wanting to support this kind of activity. Sometimes they don't always understand the VC dynamics of, what's required at that stage and what you're coming on for. First, in terms of it's not one and done. You need to write subsequent checks to support some of these companies. Second, you're there to hopefully bring some revenue potential, partnership, and collaboration to drive this. And if that doesn't show up, that's a bad thing. The worst thing you can have is having a strategic on your cap table, but they're not a customer with you. That's a long thing to explain away. And then it's the other aspect of the expectation around being the M&A outcome. So there's a few different things here, and you want to sort of stand and balance some of that, but also ensure you don't get tainted with the brush of being, you're, XYZ Bank's company. Yeah. Because then other people may not wish to work with you. So there's that balance in the flavor. Now, I think over a period of time, you've had this evolve, this notion and stigmas around CVCs. And I think there's a few different things that are helping that perception change. The main thing that can do it is where people actually show up. They show up and they do what they say they're going to do, right? Now, that needs to be from a revenue perspective and that brand and PR notion. You've got to be able to go out and say what you're doing. I think the other part is the version of not only being focused on M&A as an outcome from that client, because you want to have multiple clients. You don't want to be a one-trick pony. The other part around it is ensuring that your investment teams at CVCs have some skin in the game. They're incentivized to create an outcome and success and help the company grow and develop, not just because they're an employee of a company, but your sort of compensation should be tied to an outcome in some shape and form. And then I think it's just greater awareness around what strategic investors do and can do. Now, in the ecosystem, you've seen the stats kind of evolve and grow a little bit. You're seeing strategic investors be involved in at least 20% of deals and more. I think you also, there's a perception that maybe strategics need to be they're at later stages, but oftentimes you need that early validation or that anchor tenant, especially in the B2B space, to make it successful, right? If done well, you have this aspect around bringing in deep domain expertise in a narrow domain that your traditional broad-based generalist VCs may not be able to give you. So I think I always say you got to have both, and you got to have them together, and there's a good balance that comes in when you do that together. For example, for us in the areas of wealth and asset management, this is all we do. Hence, we can go deep, we can understand the trends, we can figure out where we're going, we can understand the implications of this company, and really potentially help guide where we think some of this may go. The other thing is sort of impact and returns. You do get that kind of credentialization. You do get that validation, especially if you're going to go and sell it to other large corporates or enterprises. If someone big is behind you, it's a validation. And then you can go out and say, look, they're using me, or they're a customer, or they're an anchor tenant. Well, then 5 other people will do. We've seen this live in cases where, because we put out a press release saying we're working with this company, we then had, the company then got 5 inbound saying, oh, now you're working with Fidelity. You can, we can look at you as well, which helps. The other thing is different kinds of CVCs, right? So you have strategically motivated, financially motivated, or a hybrid.
Because this is what I was going to ask, because you tend to see CVCs kind of break up into, well, no, we are an absolutely independent, investment fund. We have zero kind of tie back to the corporate entity. It's not off the balance sheet. It's all created separately. Versus, actually, no, it is a strategic corporate venture arm that is investing either off balance sheet or has been created specifically to invest strategically for the mothership kind of thing.
And I think there's interesting domains, right? So the one aspect is they're oftentimes birthed within a corporate, and then they're spun out. And I think that nature of how it's spun out is interesting. Some have done it very successfully. Some are in stages of learning and growth. But I think that's kind of a path to growth and development over time. It doesn't always have to be the case, but that's kind of the trajectory of where it goes. You start with an wholly owned and controlled. You develop some capabilities and track, and then you sort of say, okay, can I go out and get other LPs along this mix as well? I think the majority of, not majority, I'd say 40-ish% of the companies that are doing this are doing it with just the strategic intent, not the financial return as the primary goal. And oftentimes we'll hear it's for the technology and the innovation organizations to learn. Now, that's great. I think it's fantastic. Bring the technologies in. We sort of engage with them. We play with them. We test them. We can get inspired to do different things. But there's got to be some version of like keeping it real with the rest of the ecosystem to deliver financial returns.
Because you're doing a disservice otherwise to the founders as well.
Absolutely.
Right? Yeah.
If you're purely financially return oriented and you say, I just chuck it over the wall. If it lands, it lands. If it doesn't, it doesn't. Well, then you're kind of also doing the startup a little bit of a disservice because you're not giving them the best chance of success. Yep. You kind of want the middle, and that's kind of what we are, which is a hybrid in between. We look at things from a financial returns perspective, but we also ensure that there is a strategic partnership live or potential in the reasonable future, and we'll continue to keep at that. The same team, our same team, will do all parts of that. Yep. From identify, look at the themes, identify the companies, diligence them, and then sort of make sure that we can continue that partnership potential into Fidelity. And we've got, I'd say 60% of our portfolio has some live partnership with Fidelity today.
I mean, that's pretty impressive. I mean, there's a couple of things that come out of that. So firstly, I did want to ask, so you mentioned making sure that the team is incentivized and aligned, right, from within the investment team. So but presumably you don't have a traditional carry structure as most firms do. I mean, how do you?
So we have both. So we have an alignment towards the strategic impact, which aligns with the firm's performance and that particular kind of area's performance potentially. And then we also have the financial return incentive, which may not be pure play carry, but will have some version of aligned incentive from the performance of the brand. So maybe a shadow carry or maybe some other kind of form.
Got it.
Because we're not set up as a traditional fund structure, it doesn't work in the traditional way.
Yeah, exactly. and I guess the question then becomes, okay, because venture is a long-term game, how do you ensure that, that incentivization works over the short term as well as the long term?
Absolutely. No, I think that's right? And I think and that's why you need to have both of it, right? Because if you're a large-scale financial services organization or a large-scale corporate that's listed, you're generally thinking quarter on quarter. And those things change quarter on quarter as the cyclicality of the market moves. And so how do you play for 10 years, right? And hence, a nature of setting this up for a long term is really critical, right? That was one of the motivations of coming into Fidelity and doing this with a private company. That is private and family owned, thinking about, intergenerational shifts within this ecosystem.
Yeah. I think, I think the more I've spoken to kind of people that are very heavily involved in the corporate venture space, when they are thoughtful about what they do and when they think about it from not the kind of, well, VC's cool, let's get into it. B, actually VC is just about financial returns, but actually provide value back. And, we've had Founders Factory on the podcast. We have various people, either portcos as well as kind of members of the founding team of Founders Factory on the podcast, who've talked about obviously those strategic relationships between the investors essentially into Founders Factory and then back into those portcos. And I've seen it firsthand where those companies are providing revenue opportunities, partnership opportunities. I think that can be really compelling. I think the really scary part, I think, for a lot of founders, and this is exactly to your earlier point, is being painted with the brush of, these are the guys, this is my exit route. Like, these are the guys that acquire me. Because again, then if Fidelity or whoever it might be doesn't acquire the startup, surely that potentially is if I'm a founder that is looking to exit at point B and Fidelity is not interested in an exit at that stage, does that scupper their chances of finding some sort of an exit route?
And that's exactly right? And this is where it comes down to, how do you set up and structure how much you own, what kind of influence you have, and how you're enabling that particular company that is going to serve, that has a capability to serve the industry,
Yeah.
Right? One is you got to be set up to do sort of real minority investing. So you're going to try and stay 5, 10, 15% ownership, maybe a board seat, maybe an observer seat, depending on the dynamics and the sensitivities. But you're aligning with everybody else in that ecosystem towards an outcome. For example, for us, we're not a hugely acquisitive company. Fidelity's done a handful of acquisitions over its entire lifetime, but I think the nature of being able to say we're aligned with you towards an outcome, and the outcome is the same that everyone else may want, whether it's a trade sale or an IPO or otherwise, that helps a lot.
Yeah.
But it needs then that we're not 40% of the cap table or 50% of the cap table, because then that's a very different proposition. That's where the expectation comes in of well, there's only one route to acquisition. Right?
Yeah,
So,
there's an unbalanced kind of expectation, both from founders as well as external stakeholders, and it may put off other stakeholders from either putting additional cash in or potentially kind of pursuing the exit. I think it's super interesting. Kind of moving on from there, you wrote a great piece, which I probably could have almost written myself, on the great VC reset, as you called it, and why one of the things that founders should be doing in the current climate that has persisted since 2021 is to not dread the down round, which again is something I've written about quite a lot myself. So this leads to a topic that I think we're going to see a lot more of, which is playing with duration that doesn't match venture. And we were talking about this actually just before the pod as well, right? So can you unpack that and maybe touch on the lens that Fidelity has ultimately as a generationally owned family business?
Sure. So I think that the point there, maybe just touching on the point a little bit, and then we can talk about some of the impact it has.
Yeah.
This nature of, will do anything in your power to prevent a down round. Now, sometimes it's founder driven, sometimes it's your other investors driven, sometimes it may be corporates around the table, and maybe a whole series of people who want different things out of that outcome. What that then leads to is a range of funky things that you're going to put into your structure. It could be liquidation preferences, it could be minimum return thresholds, it could be all kinds of things which that at some point it's going to come to pass.
They're going to come back and
it's
bite,
not something that you can just hide away from, right? Now, the other side of what it does is, if you're not sensibly priced versus and taking whatever valuation you think is the most sensible at that point in time in raising money, you're also doing your employees a disservice, because they're in the ESOP. And if your ESOP are so far out of the money, why are they hanging around? Yes, they're in it because they built something, they value the organization, they value what they've done, but they've got to feel like that's going to deliver. And if you're so out of the money, or they're crushed down so far with structure, what's the point?
Yeah.
Right. So I think that's the part where it makes sense to do. Now, I think coming back to your point around duration, right? It depends on sectors, it depends on industries, and it depends on kinds of companies that may outlast that traditional 10-year fund model. Now, in reality, if anyone's an LP investor coming into these things, they want to know that there's a return potential. You've seen as a result of this a range of fund structures that are coming as evergreen, coming as ranges of different forms that enable them to have flexibility to outlast that 10-year time frame. Because otherwise, then you've got to sell into a continuation fund or sell it to secondary somewhere here and there. And then depending on the environment, you can get, destroyed on value. So I think that notion of being able to say, what is the most appropriate for the, for the sort of to survive that duration for the industry, for the kinds of startups, for the kinds of companies you're in is really important.
Yeah.
So we are seeing people being creative on some of this, right? I think the way that we're thinking about it is, one, we don't have a fund structure from which we operate. We're operating off of being allocated capital of the balance sheet each year, and then we make investments. We create sort of synthetic versions of portfolios, but that's just for our own sort of functional and administration. Yeah. But the nature of being able to then say, okay, what makes sense? And which of these companies does it make sense to hold for a short period of time to prove that they can be, successful with a strategic partnership? But then after that, we may be willing to sort of have an exit from that scenario. There may be some other ones where we wish to hold for a longer period of time because they may be highly strategic to something we're doing, or a core part of the infrastructure, or a strong distribution partnership, or something of the like. So that flexibility allows you to sort of have that and take a much longer view in this space, especially in a space where there's a huge shift going on in this intergenerational movement of wealth, an asset management industry that's going through sort of structural shifts, not only in fee compression, distribution, product construction, and beyond privates and publics. So allowing yourself to be able to play across that space makes a ton of sense. The generational shift is important, right? And I think, again, the nature of being family-owned and private, you're not just playing to maximize the quarter or the year. You're playing to create lasting businesses, and you're relying on a brand and a reputation and a credibility that's been built over generations and decades. So I think that helps us a little bit, as well as the ability to kind of, actually put it into action with some of the companies we're in. There may be opportunistic outcomes where a company you've been a couple of years out is, there's a strategic acquirer, there may be an outcome, there may be something else, there may be M&A. That's fine. And if we think it's appropriate, we're very supportive of those outcomes. But if there's opportunities where we think we may want to be in some of these businesses over longer term, it gives us the flexibility to do that.
I think, again, because I come from kind of a family background, I speak to a lot of family offices here in the UK and elsewhere. And, I guess it's interesting because Fidelity being family owned and but public facing, as in it's very, very open, and it's very easy to find Fidelity, online, as it were, and certainly the investment arm. It's a very different flavor to most family offices.
Yes.
Which remain kind of behind, a bit of a veil. It's hard, they're harder to approach, they're harder to kind of find, but they always, almost always take that very long-term approach, right? So they tend to be quicker to move, but also more patient in terms of the capital that they're deploying, right?
Yes.
So I guess, from your perspective and from I guess the ultimate owners of Fidelity's perspective, what they're doing here is, yes, creating sustainable outcomes. They're not beholden to an LP that is looking for DPI, is looking for a return. Yes, they will want a return, but they're happy to wait longer term if that is appropriate. And I guess that's probably the critical word. So when is it most appropriate to kind of play with that duration? Like, what are the sort of businesses that fit that sort of category?
It's really interesting, right? And there isn't this like magic, it looks like this.
Yeah.
It's almost, where is that reliance, partnership, collaboration the most relevant, deep, and helpful? And where can that be more meaningful, right? So I think it's almost situation by situation. Like, if you take an example of some core capabilities, you may want to own that or own more of that over a time period, right? And just be part of that, so you can.
And you only see that over time as well.
Exactly, because you may start with an use case which is quite narrow and small, but over time that might expand, and you might feel like, oh my God, I want to make sure that we have greater governance around some of this, or greater ownership of some of this, or we want to continue to hold this into foreseeable future. Now, at the end of the day, there are other investors around the table as well, so it can't be just our voice that speaks loudest in any shape or form. So I think there's a balance to some of that, but I think there is that duration piece where, for many others, you have either you're capped out from the investment perspective, or you have to force yourself into a secondaries fund or a continuation fund or something else, which again then distorts a little bit of the journey for some of that company, not always in tandem, in keeping with what maybe the founders want.
Yeah. So, I mean, the other thing that comes out of this conversation, we're talking about the down rounds and so on, and this is, as I say, something I've talked about a lot, but I'd love to understand from your view, what the state of the market is today, right? What is driving, we've seen deal velocity, deal volumes all kind of shrink this year. We do know, some of the fundamental causes of that or some of the precipitating causes of that. But, we're now a year and a half, 2 years into kind of the post-ZIRP era.
Yep.
Where do you see things at now, and how do you see things progressing, and what needs to move for the market to move, maybe?
Look, I think we're all sort of guessing and thinking and believing along the way. So I don't think there's any magic crystal balls. I wish we did. We'd all be way more.
We'd either all be rich or not have any money at all.
Exactly.
Yeah, sure.
But starting with the principle is around returns. And I think if it's not easy to realize those returns, whether it's in public markets or M&A or buyouts, everything sort of takes longer, and people take their time in terms of, allocators allocating more capital to funds taking longer to deploy into the market, and then that return taking longer to come back. So it's the time and the cycle. Now, we can all say that the 2021-22 hype cycle was too much, too fast, too big, without the same level of discipline, potentially. But now we're at that stage where we're sort of,
too slow.
and almost gone the other way because of what's happened at that time, and deployed so much capital into an asset class where you're not seeing the returns in the DPI come through in the same rate. I think the other part around it is pockets of being, going through an entire cycle of realizing that there are certain companies that are the haves and some that may be the have-nots, and investors willing to even do secondaries into the haves rather than sort of look for primary investment. I think that's a good realization. Again, that can create a healthy outcome. Early investors, angels, employee liquidity, etc. Right? So I think that notion of being able to provide some of that is actually a healthy outcome at a time when you're not getting those exits at scale. Beyond that, I think there's how long is it taking companies to grow? What are they focused on? Because when you have a slowdown in the economic cycle or uncertainty or other things, everything slows. So say you're running 50 projects, those 50 projects will cut to 25 in a big company. So the other ones get back burner. That means your sales cycle into those use cases takes longer, right? So everything slows down. So what does it mean? The companies that were aiming at these huge targets are taking longer to get there. And you want to make sure that if you're then going to have to go on and do your next fundraising round, what's your story? Have you done what you said on the tin or not, right? And that's what you're held to. What's your growth? What's your gross margin? What's your path to break even and beyond? And so that notion of saying, continue to push to be the 100 million ARR company, not so much the $1 billion valuation company.
Yeah.
Right? That mindset is shifting of being, let's see the results, not the valuation, and let's play for the focus on that more than anything else, right?
So, I mean, one of the other things that comes into this, and especially, because you guys are obviously very heavily FinTech investors and obviously within the financial services space, right, is London has always been one of the strongest regions for FinTech, right? But we're starting to see across Europe a lot of activity kind of coming up. A lot of French companies, German companies, Nordics, etc. Like all of these regions are now starting to kind of start nipping at the heels. I mean, I think the UK is still the third largest post, US and China. But how do you see the ecosystem here in the UK now? Is it changing fundamentally? I mean, obviously we've had a change of government. I don't necessarily expect you to have a view on that specifically, but how do you see that environment shifting? Is the UK still kind of the gold standard for FinTech in the way that it has traditionally been?
I think because of the nature of the traditional financial services industry and how important and how well entrenched it is in the UK and continues to be, that becomes the natural bed to allow for the innovation to happen here as well. I think that combined with a supportive, let's call it attractiveness to founders, to technologists and others, whether it's through universities or immigration or otherwise, and the supportive kind of regulatory ecosystem that allows people to experiment, sandbox environments and early stage, so sort of lighter regulation for certain different pieces of the ecosystem. So I think there's a mix there that sort of comes together well, and the breadth and depth of it within a narrow sphere in the thematic around financial services and FinTech that attracts that ecosystem into the UK, that it does continue. And we're not seeing that slow down, right? the hard part then is saying, okay, as these companies grow and scale, then what happens? Where do they go? Do they have to have a foot in the States to be able to list in the US? Or can they be large? Can they list here? Can they be successful? That's the bit that people are sort of working through and thinking through. And that's the environment that needs to continue to grow and develop to enable that. We're seeing tons of sort of regulatory discussions on some of this. How do you sort of develop further the primary markets with a series of rule changes that are coming through to enable and allow this to be an attractive ecosystem for people to list into and to allow the velocity of these companies to come through? Is it as big and as attractive as anything in the US markets? Not yet.
Yeah.
Right? But can it be in the future? Potentially. I think beyond that, the other side of it is, what other awareness incentives and things can be driven to create positive ecosystem? The other thing that we've heard before is there's a lot of early stage money.
Yeah.
There's not growth money.
Yeah.
Right.
And we talked about it a lot.
And so, and again, that nature of growth money. So there's more and more funds coming up. There's some of these being supported by the government and government initiatives, all positive towards the right outcome. But you need this continuum from, angel, pre-seed, seed, growth, and beyond, because you've done a great job of some of these tax incentivized early stage investing schemes, right?
Yeah.
The EIS.
Well, the EIS just got renewed for however many years.
Exactly.
Again.
And so I think you have to have that continuum to create that growth, and you have to have positive success stories for people to want to emulate, and where that mafia comes out and does it again in 50 different ways, right? And you're seeing some of those stories play out.
Yeah, it's interesting because I'm not sure we've seen a UK mafia yet. Not quite in the same way we've seen sort of the Spotify mafia. We've seen obviously the PayPal mafia in the US, which is probably the most well known, I guess, right? But one of the things, and you touched on this, like that regulatory environment and the listing environment is one of the things that I think feels like it's a bit of a struggle here. And it's not necessarily the regulatory or the listing environment. It's also just the attitude and appetite of the public markets in the UK, maybe in Europe more generally, to invest in kind of high growth tech. Just doesn't, they when companies list here, they often fall on their faces because there just isn't the same appetite as there is in the US. Do you think there needs to be a fundamental mindset shift in the way we approach high growth tech businesses here in the UK in the public markets, not just at the regulatory level, but just in institutional investors as much as anything else?
I think it's probably breadth and depth of investors that need to be established to be able to allow that those companies to perform better. It's not just a mindset. I think you just need more and people willing to invest into those spaces, right? And it comes from having successes, good performance, continued recurring performance, quarter on quarter results and growth. So all of these things play into that story.
Yeah, I think this is a fascinating topic. It's one that I keep threatening to get a couple of people on to kind of debate the pros and cons of, or the either sides of, because there are some advocates, or not advocates, there are some people that are very, very clear that, and are somewhat incentivized to say so, that there is nothing wrong with the UK markets. There are others that are, very kind of clear in the camp of no, that there is a big problem. We need to change things. But I think it's, to your point, I think it's evolutionary. I think if we see, to your point, more of these outcomes this side of the pond, then that creates that kind of positive momentum of success, that others both want to be part of, but also then try and replicate, right? And I think that's the important thing. So look, finally, one question that I like to end up on, what is one thing that you have a contrarian conviction on about from any area of life, whether that's work, politics, socially, or at home? What is a hill that you would die on defending? This is a trick question.
No, it's a good one though. How about I do two, and I'll do one with a professional bent and one with more of a personal bent. Sure. The first I'm going to loosely put in the category of AI, right? Huge believer in the paradigm shift that we're going through now, and what the current wave of Gen AI and AGI has to offer across tech, but also financial services and the ecosystem around us. But I think we have to be balanced as investors in understanding some of the business models underneath some of these companies, how excited they are, how lasting these business models may be, how defensible they may be, and especially against the canvas of a rapidly evolving AI ecosystem around us. Will they be around in 5 years with similar use cases? Will many of the enterprise players operating in this space be the ones that are providing the layers of efficiency and cost reduction? Does it come down to applications of small language models on proprietary data sets, especially in highly regulated industries like ours, that become more exciting across the domains, right?
Yeah.
So I think that's one where love the space, look at it directly in the areas that we think are relevant to us across, investment research, portfolio construction, portfolio management and things, but with quite a narrow lens and understanding what can be defensible over a long period of time. On a more personal note, I think it's the philosophy to slow down versus sort of rapid and instant gratification, whether it's to take time to learn something, totally new, experience something fully, or even sufficient time to just slow down your mind, right? Where we're continuously trying to multitask, run at 100 different things and overstimulate everything we do. I feel it's the only way we're going to stay sane and sort of engaged.
It's kind of the most Eastern of philosophies, right? I guess. So I think on both of those points, I think, AI is here. It is, to your point, it has shifted paradigms, but it is equally evolving at such a rapid pace that what was great yesterday, OpenAI releases something tomorrow, and okay, all of a sudden your business model is out of play. But new businesses can then kind of start building on that. I actually do think the kind of small language model versus large language model is really interesting, because I think there are some niche areas where actually large language models are too broad.
Yep.
Right. and don't have enough deep data to really power kind of decisions, outcomes, outputs that you would hope. So I completely agree with that. Definitely on the slow down and take your time. I have for many years resisted becoming one of these guys that goes, I woke up, had my run, and then did a bit of meditation. I have over the last year not only been running every day, but doing yoga, and have just recently started doing some very small kind of 5-minute meditations. But it's really helpful.
It really is. And to sort of be conscious about it, right? Yeah. In a world where we're all busy, we've all got busy, and we've got family obligations, we've got young kids running around, all of the things. It's hard to find the ways to sort of truly slow down. Yeah. I think it's really important.
Yeah. Well, look, Alokik, thank you so much for your time, for your advice, and for your thoughts. For our audience, where is the best place to find you online? You're on LinkedIn, Twitter. Where can they find you?
So the easiest is just off of our homepage at fisv.com. If someone wants to send a pitch in, we've got an email address on there. It's hello@fisv.com. Please connect with me on LinkedIn or drop me a note or something like that. That's probably
amazing. Well, look, thank you so much for joining me. It's been an absolute pleasure.
Great to be here. Thanks for the very insightful questions. Really fun.
Amazing.